Okay, are you recording? Okay, we're live.
All right. Hello, everyone. How is everybody? Good? You're awake? It's 11 o'clock? Okay. I'm Nicole Carlin, the director of the undergraduate program. Who here is not a business student? Handful of you guys? Okay. You can still listen to what I have to say. I'm just here to remind you about registration if you haven't registered yet because your window hasn't opened. To remember that registration is earned plus in-progress credit hours. So that means if you are registered for this summer at Kent State, those hours will be included in your in-progress hours. Is anybody here planning in the classroom planning to register for summer and still hasn't? Nobody? Okay. Well, if you change your mind, it's to your benefit to register for summer prior to fall registration because it could change your date of registration. The other thing I just want to let you know is that if you're not sure of your date or if you have any holds preventing you from registering, you want to go to your Flashline account under Student Tools and Courses and select on the very top left-hand corner is registration status. There it'll tell you how many earned hours you have, your date for registration, if you still have a required advising requirement, or any other holds preventing you from registering on your designated date. If you want to schedule an advising appointment regardless of which college you are in, you want to go to www.kent.edu/advising/offices. And from there you can navigate to your college. Any questions? All right, thanks guys. No, thank you.
It's not connected quite yet. Hold on. I'm not connected right now. You'll give me a 1 minute here. I'm going to have to sign out and sign in. Good. Okay. Okay. Today, I couldn't remember if it's morning or afternoon. Okay. So today what we're going to do is we are going to finish Chapter 9. We started it last week. And just a reminder about what's due this week. What's due this week is we have Attendance Quiz 20 that shows up on Thursday afternoon, our Chapter 9 homework, and Video Quiz 21's on Sunday. Tutoring. Tutoring is available today. You're not full for today. Haley's in class now. She's just up in the middle. I would urge you to go to tutoring. You could still sign up for today or talk to Haley right after class. You could still go. She can also tell you what hours she has. We have openings every day, Monday, Tuesday, Wednesday, Thursday. So this week's Tuesday, Wednesday, Thursday. I would urge you to go to tutoring with her. And do check your email. We send those out every week. So Chapter 9 is where we are today. We're going to be picking up where we left off last week. There are 5 learning objectives in Chapter 9, and we are doing learning objectives 1 and 2, 4 and 5. We're not doing 3. You didn't have a video lecture on 3. You won't see anything on study plan on 3. It's just one we don't do. This homework, there might be a lot of little problems, but they are pretty short. We're going to go through several of the homework problems today. So today is a really good day in terms of having model type stuff for homework and for exam. So the first thing we're going to do is we're going to do short exercise 9-6. And let's see, here we are. Okay, can you switch cameras on me? Okay, so short exercise 9-6. This is going to go really quick. We're only going to do the first 2 of these because they do go so quickly. The first one, Brian, can you move the cursor on whatever computer that is up there? There, thank you. Okay, the first one, we're computing the price of the following bonds. So item A, we have $200,000. That's the face value of the bonds, issued at 77.75%. What's going on there is we take the 200,000 times 0.7775 or 77.75%, and we get the price of the bond, which would be $155,500. So all you do when you do these is you take the number, the price number, and make it a percent. So the second one, it's 200,000 times 103.5%. So it's going to be higher. So we have 207,000 for the second one. The first situation where we have a bond issued at below 100%, that's known as a discount. We're selling it for less than the face value. The second situation, situation B, we're selling it for more than face value, so that's known as a premium. Okay, and we're going to do a lot more of these today. And like I said, we're not going to do C and D because they work just like A and B. Okay, so first true-false question of the day is up next. A bond with a face value of $1,000 and a quoted price of $102 has a selling price of $1,020. Is that true or false? Brian, what do you have? A bunch of truths and going up. And that is absolutely true. You take the $1,000 times 102%, and you do get a price of $1,020. That's a premium because it's selling for more than its face value. So that one is true. Next up, we have another homework exercise. And this exercise is short exercise 9-7. This is a really good example of having to be able to distinguish whether something's a premium, a discount, or at par value. When bonds are issued, there are three choices. We can issue them at par value, we can issue them at a premium, or at a discount. On Thursday last week, we had a table that said if the stated rate is equal to the market rate, it'll sell at par. And then we had the next item down, I think, with a discount, and the next one with a premium. And that's what this exercise is asking you to use. That table that we referred to last Thursday, critical to put on that exam sheet. This first situation, market interest rate is 7%. So the market's paying 7% right now. Horton Corporation issues bonds payable with a stated rate of 6.5. So every investor can go to the market and get 7%. So Horton comes along and says, buy my bonds, I'm paying 6.5. No rational investor is going to get those bonds because they pay less than market. So what Horton has to do is they have to give them a discount to entice them to buy their bonds. So that first situation, situation A, is going to be a discount. Okay, so we have a discount for A, and I guess I spaced ahead here. B, we issued 6% bonds, so A is a discount. Now B, Sharp Inc. issued 6% bonds payable when the market rate was 5 3/4. So market's paying 5 3/4. Sharp goes to market and they're paying 6, so they're paying more than that market rate. So they can now command a premium for their bonds. So that's why B is a premium. C, Houston Corporation issued 3% bonds when the market interest rate was 3%. That's a situation where they exactly equal. We say they sell at par or at face value. So that one is par value. Par value or face value. And then finally, Ontario Company in D issued bonds payable that pay stated interest of 8%. So the bonds pay 8%. The market's paying 8.25%. So investors can go to the market and get 8.25%. No one is going to buy Ontario's bonds unless Ontario says, hey, I'll sell them to you for a discount. I'll sell them to you for less than the face value. So this D is going to be a discount as well. So D is a discount. Those are examples of situations you should be able to tell whether this is a premium or discount situation or par value. Okay. Next up, a question. Okay, true, false. If the interest rate on a bond is 8% and the market interest rate is 7%, the bond will be issued at a price above the par value of the bond. True or false? Sorry, it's not real exciting, but when people leave, you should talk to them as they walk out the door. Yeah, like say hi, do you need shoes reading? You know, just casually strike up a conversation at the end there. See how many you can get. Brian, how many do you have? 9. Okay, 9 truths, 4 falses. So we think about this. This should be a pretty straightforward one at this point. You should be able to answer this, especially with looking at that table. The bond pays 8%. Market's paying 7%. People going to want our bond? Sure, they're going to be willing to pay extra. So they will, this is true, and the bond will be issued at a price above. It's issued at a premium because it's paying more than the market. So this one is true. Okay. Next up, we have an excellent little exercise. It's with some basic journal entries about when a company issues a bond, what happens. And this one, we have this one and then we have another one coming up that alters the situation slightly. So this situation, exercise 9.8, Hunter Corporation issues 7-year bonds payable with a face amount of $125,000. So these bonds have a face value of $125,000 when the market interest rate was 8%. Okay. So then we assume that the accounting year ends on December 31st and the bonds pay interest January 1 and July 1. Bonds typically pay interest twice a year. So the first situation, A, issuance of bonds payable at par on July 1st. So July 1st, 2012, we issue the bonds. It tells us at par. What does that tell us? The fact that it's at par tells us that the market rate and the stated rate on the bonds are exactly equal. That's the situation. Notice it doesn't specifically ask you that, but you have to know that when it says at par. At par should be a signal to you to say my face value, my stated rate on my bond is equal to the market rate. So we go back into the facts. The very first sentence tells us the market interest rate was 8%. So we know the stated rate has to be 8% because they were issued at par. Sometimes the problems will tell you what the stated rate is and what the market rate is. But in this situation, they don't have to tell you because par means they're both the same. So they can give you one and you know the other. Now in a situation where you have a bond selling at a premium or discount, they will tell you what the stated rate is because you're not expected to calculate what the rate is. So if it's issued at par, you know that the two rates are the same. So this issuance of bonds payable at par on July 1st. So what's happening here is when we issue a bond, we're doing this from the company's standpoint of issuing the bond. Why are they issuing the bond? Because they want cash. So they're issuing a bond, they're receiving cash, so their balance sheet increases for assets, and they're also taking on a new debt. So what we're going to see here is we're going to see a debit to cash because they're getting cash for these bonds, and it's going to be for $125,000. They sold them at par. So $125,000 debit to cash and a credit to bonds payable for $125,000. This is the most simple situation you can have of issuing bonds. So the journal entry is going to be as displayed. We debit cash, credit bonds payable for the $125,000. Okay, next item down, accrual of interest expense on December 31st, 2012. So what's happening here is December 31st comes along. The Hunter Corporation, again, this is for Hunter Corporation, they've held these bonds for 6 months. So when they've held these bonds, they issued these bonds 6 months ago. So they've held the cash. They have the money. They've had it for 6 months. They owe the interest on it, but the interest isn't paid till January 1. That doesn't seem like a big deal. This is December 31st. But it is a big deal because our investors need to know that first of all we had interest expense for the 6 months and that we owe the interest for 6 months. So what we're going to do for Part B, we're accruing interest expense on December 31st. So what we'll do is we'll take the $125,000 times 8%, times 6 months over 12, because interest is paid twice a year, and that rate that they give you is an annual rate. So what we're going to do is we are going to be debiting interest expense, crediting interest payable, and I'll pause for a minute, let you write it down, and then I'll talk a little bit more about that. Okay, so this accrual of interest, we're going to be debiting interest expense, crediting interest payable. Whenever you have a journal entry to accrue interest, it is going to look like this for bonds payable. The amount, you're going to take the face value. Always take the face value. It doesn't matter if the bond's issued at a premium or discount or at par. Your interest is always calculated by taking the face value times the stated rate, and then you'll usually have to adjust it for being half a year. Typically, bonds pay interest for half a year. And then, so there's the $5,000. So we debit interest expense, we'll credit interest payable, so we're recognizing expense and we're also recognizing a liability. So that's entry B. Now, entry C. Entry C says, okay, we accrued this December 31st. Now we're going to pay it January 1. So we're in a new year and we need to pay this interest. So the first thing we're going to do is we're going to pay the cash out. We are going to credit cash and we're going to debit. For our debit here, we want to wipe out that liability, and we no longer owe that $5,000. The $5,000 comes from entry B. We set up the liability on December 31st. We owed it. We issued our financial statements. Now it's January 1. We're paying it. We're paying the interest off, so we no longer owe that. So we're going to debit interest payable to get rid of that liability, and we're going to credit cash. Okay, and then the last entry, so this C was when we pay the interest, the stated interest, and the last entry is payment of bonds payable at maturity. So we're paying the bond off at maturity. When we go to pay the bond off, we have to give the date. So we look at this, and we issued them on July 1st, 2012. They're 10-year bond, 7-year bonds. So 7 years on to 2012, we are going to have 2019, July 1st, 2019. We will debit bonds payable and credit cash. We're wiping out the liability and we're also paying out cash, so we're reducing cash. This exercise, we had entries A, B, C, and D that gave us 4 different entries. These entries are very, very standard. These are good example entries that you might need. Whenever you issue bonds payable at par, that journal entry is going to look like the journal entry we had for A. If we accrue interest expense on a bond issued at par, it's going to look like B. So these are good sample transactions. You may want them on your review sheet if you want that. Note that this is going to be a little bit different than an exercise coming up because this one, the bonds are issued at par. So certainly label this all is issued at par. Entry D is going to be the same whether it's issued at par or not. But the other ones, C and D are going to be the same regardless if they're issued at par or not. A and B will be different if it's issued at a discount or premium. But this is a really good exercise in terms of having some basic entries. So that concludes exercise 9-8. So now we have another question or two coming up. Okay, first one. Current maturities of long-term debt are reported separately from long-term liabilities. Current maturities of long-term debt are reported separately from long-term liabilities. True or false? Down there and practice for a while. So when I'm down there, you might need to point that to me because I'm going to be off to the side. Okay. So yeah, I'll probably end up over there, is my guess. But I need to watch my screen here. It's hard for me to do from there because I can't see the, there's a lag time between the two. Brian, what do you have on this one? 11 truths, and that is absolutely right. Current maturities of long-term debt. Let's say you yourself have a 30-year mortgage and you know that you're going to be making payments every month over the next 30 years. The principal payments that you're paying, that you're scheduled to make over the next 12 months are not long-term debt. They're actually called current maturities of long-term debt. That's one interpretation of it. So companies, what they do is they have a long-term debt, but the part that they have to pay in the next 12 months goes on the balance sheet under current liabilities. Because when we see current liabilities on a company's balance sheet, that tells us what liabilities that company has coming up due in the next 12 months. So this one is true. Current maturities of long-term debt are reported in the current liability section, separate from long-term liabilities. Now, on to another exercise, exercise 9-11. This is the other exercise that has a lot of journal entries in it, and this is definitely one in conjunction with the last one that we did, that I would have these journal entries on my sheet because this will get you through most situations. Okay, so we have a bonds payable problem. And it tells us that the company Starlight borrowed money by issuing $3 million of 8% bonds payable at 97.5. Right there, we've got some facts being given to us that are important. We issued $3 million. So $3 million is the face value. That's what they will pay back at maturity. The $3 million is what the interest, cash interest is calculated on. 8% is the stated rate or coupon rate on the bonds, and then 97.5 is the price of the bond. So if the price is below 100%, did this bond sell at a premium or discount? Discount, yes, because it's below 100. So we know right now we have a discount. On July 1st, 2012, the bonds are 10-year bonds and pay interest each January 1 and July 1. Okay, so first question, how much cash did Starlight receive when it issued the bonds payable, and write the journal entry. So the amount of cash that Starlight received when it issued the bonds, it's going to be the $3 million times the 97.5. This goes back to that first exercise we started with today. If you have a price and a face value, you multiply them to get how much cash they got. So in this case, they get $3 million times 97.5. And I put the journal entry up here. Go ahead and write it down. I'm going to pause for a minute, and then I'll talk through how I would have gotten that journal entry, the order. Okay, so what we see on this one, in this journal entry, is we see that, first of all, the first thing in our journal entry is our cash. Our cash is the easiest number to get. So we're going to take the $3 million cash of the face value times the price. So that was the $2,925,000. That one's easy to get. We can calculate cash. Cash is always the price times the face. There we go. So then we go on to the next entry. I would skip the second line. Whenever I did this journal entry, if I'm issued at a premium or discount at a price not 100%, I'm going to skip a line and I'm going to do my bottom line. That credit to bonds payable is always going to be the face value. You can label that. That credit to bonds payable when you issue a bond is always going to be the face value. So you've got two amounts that you can calculate. You can calculate that cash debit, that's how much cash they're getting, the price times the face value. You can calculate the credit, the bond payable credit. It was always going to be the face value. Will not change, doesn't matter at all. So then what you have is you have your debits don't equal your credits. I'm assuming I'm skipping that line called discount on bonds payable. So at that point, you know the difference. The difference between your cash and your bonds payable, in this case, is $75,000. So I put it on the side that needs it. To make my debits equal my credits, I have to include a debit here for $75,000. So the only thing you have to determine now is whether we put the word discount there or whether we put the word premium there. Now you can remember this a couple different ways. First of all, our price is below 100. It has to be a discount. I would say that's the easiest way to remember that is our price is below 100. If price is below 100, we are in a discount situation. So that second line is always going to be a discount. You can also memorize or write down that if it's debited in this issuance journal entry, if it's debited, it has to be a discount. This is not in this problem, but if we had credited it here, or if we had issued it at a price of 103, we would have a premium, and then that premium would be credited here. Okay? So premium goes on the other side, but you'll know which side it is by which side the debits have to equal the credit, so where you need that number. So this is a very good example of a journal entry. I think your homework you have the discount on so that it'll look like this. Next question down then, that's question 2. Question 1. Question 2, how much must the company pay back at maturity? What's the maturity date? Well, they pay back, the answer for this is always going to be the face value. You pay back the face value no matter what. So the face value of these bonds is $3 million, so you're going to pay back $3 million. And maturity, these are 10-year bonds. If we look at them, 10-year bonds, it says, yeah, 10-year bonds. We issued them July 1st, 2012, so add 10 years onto that, you get July 1st, 2022. So that's all they're asking for in Part 2 then. Okay, question 3. How much cash interest will Starlight pay each 6 months? So how much cash interest will they pay each 6 months? So this one's pretty standard too. Cash interest is always going to be your face value times your stated rate, and then you might have to divide, you usually have to divide it by 2. So in this case, we have $3 million face value times 8% times 6 months divided by 12. It tells us in the problem that our bonds pay interest every January 1st and July 1. So by telling us that, that rate given is an annual rate. So our cash interest is going to be $3 million times 8% times 6/12. So what we're going to get is, actually the answer is $120,000. Okay? So $120,000, how we get it is $3 million times 8% times 6/12. Okay, so what we've done so far and for parts 1, 2, and 3 has been pretty straightforward. Now, part 4 is the hardest part to understand because there's a couple different things you have to think about. Now, part 4, when we look at part 4, up to this point, we know how much cash they received. Now think about when they received cash. When they received cash on this bond, they received, I believe, $2,925,000. Okay? So they received, and the reason they received it is because the reason they received less than $3 million is because their bonds paying less than market. They don't tell us what market rate is. They tell us the bond's paying 8%. They don't tell us market rate, but we know that this is paying less than market rate because it's issued at a discount. Again, that sheet where comparing the stated rate to the market rate, we know that this is issued at a discount. We know the market rate has to be higher. And why did they do that? Well, their bond is paying 8%. Let's just guess and say market's paying 10%. I don't know what it is. We don't need to know what it is. But just say for the sake of argument, market's paying 10%. No one is going to buy this company's bonds paying 8% if they can go get 10% somewhere else. The way that the company entices people to buy their bond is to say, I know my bond pays less interest than everyone else, but I will give you a discount. So I will give you some money off my face value, and that money that I give you off is like interest. So what this company did, Starlight did, is they in 10 years are going to pay the bondholder $3 million. But the bondholder only had to pay $2,925,000 today. So the bondholder pays $2,925,000 today, and at the end of 10 years, they'll get $3 million. So that discount the bondholder got, the $75,000, is interest in effect. It's additional interest because the bondholder gets that $75,000, but the bondholder also gets the cash interest. This $120,000 here, you're going to see this in part 4 too. So the $120,000, I want to remind you, is the 8% times the $3 million times 1/2. That's the interest that the bond pays. But the company, Starlight, is actually paying that interest, plus it gave this discount. Now the discount isn't all in one period. They give the discount, and at the end they'll pay it all back at once. But what we do with that $75,000 discount is we spread it over the 10-year life. So what we do is we take the $75,000 and divide it by the 10 years and say, well, we'll take $7,500 a year. We'll recognize that as additional interest expense. Now, so $75,000 divided by 10 years, $7,500 a year. But that's for a full year. Our bonds pay interest twice a year, so we have to take the $7,500 divide by 2. So what I'm going to do now is I'm going to put up the calculation for interest expense. I'll let you write it down. It's going to show up in just a minute here. I'll let you write it down, and then I'm going to walk through it one more time. Okay, so there it is. Interest expense, the answer for the first question being asked in part 4 is interest expense is $123,750. How did I get it? $120,000 plus $75,000 divided by 20. And I'm going to talk through that again one more time, but I'll wait for people to quit writing. Okay, let's go through that one more time. Interest expense, because when we have a premium or discount, it's different. So we always have our cash payment, the $120,000. That's how much cash we're paying. But the discount is amortized, and we're only doing it for this class straight line, which means we'll take that whole $75,000 discount, divide it by 10 years, and then divide that in half. The equivalent is what I have here. How many interest payments are there? It's a 10-year bond. They pay interest twice a year, so 10 times 2 is where you get the 20. Either way works out. So we're taking the $75,000, dividing by the number of interest payments to get, and actually we get $3,750 of discount amortization. Discount amortization is extra interest, and it gets added to the interest that we pay. So we're paying out cash of $120,000, but we're recognizing $3,750 of discount amortization, which is interest expense. So their interest expense each 6 months is $123,750. Now the journal entry, we have 2 journal entries it's asking for. Journalize the entries for the accrual of interest and payment of interest. So these are going to pop up. I'll let you write them down, and again, I'll walk through those 2. So there's the journal entries, and then I'll walk through them in just a minute or 2. Okay, first journal entry, December 31st. What we've got there, that is the journal entry to accrue interest. So the first thing we have is the interest expense of $123,750. We just calculated it. That is our interest expense for every 6 months. That will not change over the life of this bond. Every 6 months we will accrue that interest. So we have the debit to interest expense for that amount. Then our credits, we have a credit to the discount payable, or the discount on bonds payable of $3,750. That's the amount of the discount. And then we have the credit to interest payable for $120,000. And that's the actual cash interest amount. So that's what we do on December 31st, because December 31st we have a liability for the interest, and we have the expense for the interest. Then on January 1, we pay it. So we have to acknowledge that we are sending cash out the door, and we're also wiping out the liability. So we're going to debit interest payable and credit cash. This is an excellent, this whole exercise. You better sign back in. Okay, if you're in the room, just hold on. Brian will get you back. We'll get the display back on. Okay, so that last part that we had, you're just going to have to go back in to collaborate. Okay, so while Brian does that, I'll just talk and entertain here. Yeah. This morning, by the way, for those of you, we had class this morning at 9:15, and we came in and we had no projectors. They were totally non-functional. So we had to have class with people looking at their phones, but everyone online was fine. So, so it just must be our day for fun. Yeah. Okay. Yeah. So Haley, is everyone still online fine? Okay, so you haven't lost connection. Audio still good? Can you check with people? Okay, so that exercise 911 was a really good one to have on your sheet, and so that combined with the one before. Okay, so we're back, right? Okay. So we are good. Okay, so this one, I'm going to ask for a show of hands in a minute, but this one, a current liability must be paid out of current profits. True or false? Okay, how many people say true? How many people say false? Wow. What about online? Okay, so predominantly. This is absolutely false. So that's great. Terrific. This is false because we don't have to be profitable to pay our bills. Amazon went years without showing a profit at all. Current liabilities are paid from cash. You need cash to pay bills. And so how does Amazon operate without a profit? They operated by getting funding from investors and creditors. So current liabilities must be paid out of current assets usually. Okay? They pay from cash. Okay, another true-false one's coming up here. Quick little one. Next one up. Purchasing merchandise inventory on account results in a liability. True or false? Okay, what do you have? 17 truths, and that is true. So good job. Yeah, this is just like in the beginning when we had these. If we purchase merchandise on inventory on account, we're getting inventory and asset, and we're also increasing a liability that account's payable. So that is true. Okay. So now we're going into the last homework problem that we have today, and then we have a series of questions after that. So the last homework problem we have is short exercise 915. And what we're doing in this short exercise 915 is we're looking at how we construct the liability section of a balance sheet. So we've seen the assets before. Now we're in liabilities in this chapter. And what we've got here is we've got a list of accounts they gave us, and we have to do the liability section of a balance sheet. So a balance sheet is typically going to have all our assets listed first, and then we'll have liabilities. So with this particular one, we will go through the list, and the first thing I would do is I would look through the list of items and eliminate anything that's not a liability. I would look through, and first of all, bonds payable. Bonds payable is a liability. Usually anything with payable in the title usually is a liability. The next item down, equipment. Is equipment a liability? No. Okay. So no, equipment is a what? Okay, equipment is an asset. Current portion of bond payable is a liability. Notes payable, basically as we go through that list, we see payable, payable, payable. That's usually a very good, strong indication that that is a liability of some sort. We get down to the bottom and we get to accounts receivable. accounts receivable is an asset, so it's not on our list. So out of all these items, we cross off right away equipment and accounts receivable. What we're going to be doing is we're going to be categorizing the rest of the items into two groups. So our two groups of items are going to be current liabilities and long-term liabilities. This is what we're doing. We're taking all those accounts and splitting them into those two groups. That's how we do our liability section of the balance sheet, is it's split. And the reason it's split is as an investor, as a user of the financial statements, I want to make sure the company can cover their liabilities. And it's important to me whether those liabilities are due now or way in the future. So that's why we break liabilities down into these two groups. So the first thing we do is we go through that list and we pick out all the current liabilities. What I've got here, it'll show on the screen, it loads the there's three current liabilities in that list. We have accounts payable, the current portion of bonds payable, and interest payable. Those three are all the current liabilities. Current liability means they're due within the next 12 months. Yeah. Yeah. There's my current liability section. So that's everything due within 12 months. Now I do the long-term section. I'm going to put it up here, and then I'm going to talk about the bottom item, the discount, in just a minute. But I'll put it up there for now, and then I'll talk about it in a couple minutes. This bottom long-term section, we have notes payable, long-term, bonds payable. Typically note payable is first, bonds payable is typically second. Back up to current liabilities. The first current liability typically listed is going to be accounts payable. I can't think of a situation where you wouldn't have it first. Is it wrong? If you don't, I don't know. But typically accounts payable is first, then those other two are in there. Interest payable is almost always current, again, unless it says long-term. So back down to the bottom where we have bonds payable. Bonds payable in this problem, the face value of the bonds payable is $375,000. They were issued at a discount, so we have this account called discounts on bonds payable. That is a contra liability. So we have a contra liability. It offsets the bonds payable. So we show that as a reduction. If this were a premium, it would be added to bonds payable. Premiums get added, discounts get deducted. So when we go for our total liabilities, that's going to be our total current liabilities plus our long-term note payable plus our net bonds payable. And our net bonds payable is the $363,750. So that is the liability section of a balance sheet. We split it into current and long-term. Now coming up, I've got about 5 questions, I think, or so left, because this is the end of the homework for Chapter 9. And now we have a couple questions just kind of reinforce what you need to know from this chapter. The first one is a true-false question. The discount on bonds payable, so we just saw it. Does it increase a company's liabilities? True or false? You guys are it because you're right here by me. Yes, sir. True or false? False? Okay, good. It is false. Is that what you have online? Okay. This is false. Discount reduces liabilities. It's subtracted from it. If it were a premium, it would be added to it and it would increase liabilities. Discount on bonds payable is a contra liability, so it offsets bonds payable. It's like accumulated depreciation is a contra asset. Allowance for doubtful accounts is a contra asset. This is a contra liability. So it belongs in the liabilities, but it's backwards. Okay, another question, and again, that table where we're comparing the stated rate to the market rate becomes very critical. We have a true-false question coming up. If the market interest rate is greater than the stated interest rate, the bonds will sell at a discount. True or false? Stated interest rate, say stated interest rate is 8%, say market rate is 10%. That's what this is saying. So market rate's 10%, stated interest rate's 8%, the bonds will sell at a discount. Okay. That is true. Okay, we're going to have to sell at a discount. The only way anyone's going to buy our bonds if we're not paying as much as the market is to give them a discount. So this one is true. Another one coming up here. These are going to go quick. I think we have three or four more. The next one, read carefully before you answer it. If 120,000 face value bonds, so the face value of the bonds, 120,000, are issued at 104, the proceeds received will be 104,000. True or false? What do you have, Brian?
15 falses.
15 falses. Very good. 0 truths. Okay. So obviously you read close enough. To figure out the price, the proceeds, you take the 120,000 times 104%, which is not 104,000. So this one is false. Okay, another one that's very similar to one we had earlier, but it is a little different. If the interest rate on a bond is 5% and the market interest rate is 7%, the bond will be issued at a price above the par value of the bond. True or false? Okay. What do you have on this one? 12 falses and 3 truths. And this one, the interest rate is 5% and the market interest rate is 7%. The bond will be issued at a price above the par value of the bond. So we're saying our bond's paying 5%, market rate 7. We're going to have to issue at a price below the par value of the bond. So this will actually be false. I don't have an answer slide for this one. So this one is false. If the interest rate on the bond is 5%, market rate is 7%, we're going to have to issue at a discount to get anyone to buy this bond. Okay, and then is this our last one? Okay, our last question, again in that same vein, another way to ask it, if the market interest rate is 6%, a $10,000 7% 5-year bond that pays interest semi-annually would sell at an amount what? Less than face value, equal to face value, greater than face value, or the stated value. So market rate 6%, stated rate on this bond is 7. What do you have? 12 C's and an assortment of other ones to a lesser degree. And the answer is C. If our bond pays 7% and the market's paying 6%, we're going to be able to sell that bond for a price above the face value. So the answer is C, greater than face value. So then that brings us to the end for today, and I will see you on Thursday. We are going to start Chapter 10 on Thursday.